Welcome to Early Edge Club, where we break down one microcap or SME stock a day using our simple structured 20-factor scorecard. Microcap investing can be rewarding, but it's also full of traps. Our goal with this series is to help every retail investor avoid the common mistakes and develop a more thoughtful approach when it comes to investing. If you're new here, I recommend checking out the explainer video on how to use the scorecard. Try scoring the company yourself as it will give you real hands-on clarity. Today's section is divided into understanding first the business model, the industry, and then we use our 20-factor scoring, and finally our take on valuations and risk. This company analysis and discussion are part of our internal conversation as we review companies from our ongoing 500 plus microcaps and small cap stocks. We are sharing this to retail investors can build a structured framework when it comes to microcap investing. Just to be clear, this is not an investment advice. Our goal is to help you invest smarter and safer and not tell you what to buy.
The company I'm presenting today is Lehar Footwears Ltd. It is a Rajasthan-based ISO-certified mass footwear manufacturer and distributor. It specializes in non-leather footwear for men, women, and children. So they produce slippers, sandals, shoes, everything. And their portfolio includes products made from PU, PVC, EVA, and TPR. All these are basically like copies of leather, but not original leather materials. They are made from synthetic materials. The company has a capacity to produce 6.94 crore pairs of shoes, and this is as of March 24. So by now, this number would have obviously gone up even more. It operates through trade distribution, government tenders, and it also exports its products. So exports constitute 19% of its total revenue. Domestic traded and manufactured goods 49%, and they have certain contracts and tenders with various state governments, which constitute 32% of their revenue. So moving ahead, their IPO was in 1994. It was very old. And recently in 2023, they had a preferential allotment through issue of share warrants. So they raised 20.8 crores through this allotment. And the purpose of this allotment was to augment net worth and to broad base the capital structure to meet increased working capital requirements and to fund long-term requirements and for some general corporate purposes. So I've given a 3. Moving on, Rajkumar Agarwal is the chairman and MD. He holds 9.86%. Naresh Kumar Agarwal is the old-time director. He has 8.59%, and Pramod Kumar Agarwal is the executive director who has 8.28%. And there was no legal issue, regulatory issue, and their track record was clean, so I've given a 5. Going ahead, they had around 6 crores of loans which they had given to and taken from their companies where their directors were majority shareholders. Other than that, there was nothing major. So I don't think it was a big red flag. So I've given a 5. And this was only one company where this has happened, not multiple companies or anything.
Okay.
Their board has 50% independent directors and 50% of them are family. So these 3 board members are basically their nephew and 2 of his uncles. Moving ahead, so the CEO salary was less than 0.5% in the last 3 financial years, given a 5. There has been no resignation in the CEO or CFO. Neither has the auditor changed since 2022, and that was because of expiry of term. They didn't resign, so no issues over here. I marked it a 5. Then auditor opinion remained unmodified in both the years. So regarding the credit opinion, so their long-term rating was marked as CRISIL triple B minus, and the short-term rating is CRISIL A3. So triple B minus wasn't. I thought this one could be slightly better, so I've just marked it at 3 for now. Moving ahead, there was a minor dispute over some contract which they had signed with the Tamil Nadu government over some manufacturing of Velcro sandals. So basically, what happened is that the government tried to change the terms of the contract, and there was some case regarding this issue, but there was no major fine or penalty or anything like that. Like it was misunderstanding. So no issues over there. So just marked it a 5. Coming to the financial health, so they didn't reveal their concentration risk. It was not published publicly, but exports constitute 19%, domestic is 49%, and government tender is 32%. So basically, they depend quite a lot on the government tenders and contracts for their revenue. So in case one year they don't get a contract, or in the future the government just decides to stop giving this company orders, then that it might face some issues. So I've given it a 3 because of depend. Moving ahead, the revenue growth and the receivables to revenue is in line with its peers. 60% of receivables are not due for payment yet, and the remaining 20% are due for less than 6 months. So 80% of the receivables are basically either not due or less than 6 months. So didn't see a big issue over here. But fine.
20% due for less than 6 months is very less percentage. Or is it a typo? Like 80% due less than 6 months?
So 60% is not due yet. It's still going to be due for payment. That's what the annual report mentioned.
Okay.
60% is still to become due, and out of those which are due, 20% is less than 6 months, like that.
And the rest 80% is more than 6 months.
So this is cumulatively 80%. 20% is more than 6 months, like that.
Okay. Okay. But still, receivables as a percentage of revenue is consistently, or at least for the last 3 years, it's quite high.
It is high, but this was the same trend observed in the rest of the peers. I'll move ahead. Operating cash flow to EBITDA was negative in FY 22-23, and the reason for this was again receivables and inventories had piled up. But now it's coming back, it's recovering, and FY 25 has actually done pretty well. So I've just given it a 3. Then inventory trends, overall, there are similar patterns as the peers, and the inventory days are actually lower than the peers. Like peers had almost 200, 250, some of them. So I've given it a 3 because it's still high, but it's better than peers. Cash conversion cycle, basically in the last 10 years, all the ratios have changed in favor of the company. So everything has improved. Payable days have increased, receivable days have come down, inventory days are same, and cash conversion cycle has reduced at a 5. Fixed asset turnover is same as their peers, same in the similar range, and there has been no major capex expansion. All the capex which was done was just regular maintenance capex. Asset turnover could be slightly better, but again, it was same, so it's an industry-wide standard, so I've just given it a 5. Coming to debt equity, they have some level of debt, and their interest coverage ratio also could be slightly better, so I've given a 3. Liquidity position, its liquidity position was better compared to their peers, and it's significant enough, so I've marked a 5. ROE and ROCE are poor, but again in line with their peers, so I've given 3. And growth consistency given 0 because the COGS is very high, so their gross margin is almost 20 to 30%. Especially in the last 4 years, it has improved, but still it's not too high. And that margin is extremely low, it's just 2 to 4% last 4 years. Very poor profitability, and that's why I've given a 0. So going to the strategic growth outlook, government orders are basically what is driving their revenue. So there are 298 crores of NSIC contracts under the PM Vishwakarma scheme. This is for a period of 2 years. Then there is a 98.7 crore contract with the Tamil Nadu government for school bags for children. And this is to be undertaken in FY 26. So there is basically there is a strong pipeline of orders coming through to them. Then strong B2G positioning, which is business to government with positioning with 32 plus percent revenue coming from the government. And there is a 260 crore order book as of December 2024 to be completed within 12 to 18 months. So they have strong orders coming from all these governments. Then, so their channels, they basically are scaling using DMart, First Cry, and other modern retail channels. They have pan India distribution and their exports are growing along with their private sector sales as well. Coming to industry tailwinds, India footwear market is expected to reach 1.91 lakh crore by 2028, and the non-leather share is expected to grow from 25% to 70%, 75%. And out of this market, 70% is still unorganized, so there is a lot of scope for formalization. And this is where the company will benefit. Coming to operational readiness, so their annual capacity, as I mentioned, is 6.94 lakh crore, 6.94 crore pairs of shoes. They are ISO certified and they are also BIS compliant. BIS was basically a new regulation which came out in FY 24. So all new shoes had to be manufactured according to this standard. This is also one reason why their sales fell in FY 24 because the older non-compliant shoes, they were piling up inventory across the entire industry. So everyone started dumping their non-BIS compliant shoes before it got banned or stopped from being sold. So this change they had their all the older inventory was getting dumped into the market. It was pushing the prices down, and that's why the revenue fell. Moving ahead, they have received a government aid of 3.6 crore out of 9 crores, which is going to come in the next 2 to 3 years. And there is a strong focus on cost, compliance, and tech upgrades.
Before we deep dive, quick note, we are opening Early Edge Club to a small founding cohort of 15 to 20 serious microcap investors. We are building a research first community where we break down businesses together. Every month, we deep dive into two microcap stock chosen by the community. You will be surrounded by thoughtful, like-minded investors from diverse backgrounds, and we are keeping this group small intentionally to preserve the quality of discussion and make a real personal connection. If that sounds like the kind you want to be part of, fill out the short form linked in the description and we will reach out to you soon. Smart Analyze is a Chrome extension which I would suggest everyone to use. It gives a good idea as to how the current price is when it's compared to its intrinsic value. Okay, 448 crore market cap, but the PE looks expensive and there's no one-off in the PAT as well for a company that is not owning a brand, correct? They don't have any brand per se. They don't have a brand per se.
They have a brand, but it's not like a very well established or a very highly reputed brand. It's a very localized brand. So they don't have that recall within them. It's not like an Adidas or a Reebok or something like that.
And the jump in the latest quarter is mainly because of those government orders, correct?
Yes, yes.
Okay,
That
so
is basically providing them very steady order flow in the line is fulfilled because of those orders. They have signed long-term contracts, 2, 3 year contracts with Tamil Nadu government. Even with Andhra Pradesh government, they are having some dealings.
so we need to closely monitor those flow of government orders. If it stops, then the revenue drops as well. So
Yeah.
most of
Yes.
growth has come in the last couple of years. It has been pretty stagnant. But then operating margins are in the range of anywhere between, since COVID, it has come to single digits. Before that, at least they were hitting double digit. And it
Yeah.
looks like it is in the higher end of the range currently. So let's see how that pans out. Anyway, extrapolating the current growth trend, what this tool does is it gives us the best case and the worst case in terms of revenue for the next year and takes the gross margin, the operating margin, which we can, based on con calls and estimate, make changes. Definitely price to earning 74 is too much. I would be extremely conservative for these kinds of business. I would not give more than 30. Even 30 is an upper end of the price to earnings for me because the moat for this business I can't find much. It is a very price sensitive and tender kind of business. So based on that, we are getting a price of 239. The current price is somewhere in that range. There is no pretty much margin of safety at the current price. It's priced to perfection using the simple tool. We also have a reverse DCF, but let's just try that. Let's see what growth rate it is giving. So if our return expectations are 20% for a microcap investor, that's the minimum because we're taking higher risk, and for 5 years, and a trailing multiple of 20, being a bit optimistic. So basically, it means the company has the implied growth rate for the company has to be at least 16%. If it doesn't grow at this rate, then it doesn't justify entering into this. And with that
Right.
return expectations of 20%. So kind of price to perfection. What was your overall score for the company?
So overall score was 79,
Hmm.
44 in government and promoter behavior, and financial health was 35.
Another good thing is like the promoter has been increasing their stake consistently for quite some time. That is something to look into. And they looks like they are optimistic, if I'm not wrong.
One of the promoters recently passed away, like the original founder. So one of them, so maybe some shareholding change happened during that time as well. and they must have
Okay.
transferred it to someone
Transfer
else.
it to someone else. Okay. Cool. Cool. Anything else you'd like to add?
So the only thing I noticed was that the company is, I would say, lucky that they are getting so many fixed orders from these government and government entities. But that is the only thing which is unique about them. And if this thing is on, then they have the moat. Their product is very highly standardized.
It's
And
very
yeah, basically, there's nothing unique about them. They don't have a strong brand. So very standardized product.
true.
So that's the
Yeah.
issue.
And and at
Yeah.
45p, the margin of safety is very less. I hope you found this framework useful. If you follow this company or have any interesting insight, we would love to hear from you. Drop a comment below. If you have scored this company using our 20-factor scorecard, feel free to share your score and how it compares with ours. If you found this useful, consider subscribing and also check out other videos where we break down more microcap companies and SME companies. If you are interested in joining our small research first cohort, the link to apply is in the description below. Thank you for watching and we will see you in the next one. Bye bye.